Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing BCE stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 41 billion Canadian market cap. They're trading at $45 a share and they have 904 million shares outstanding. We'll look at the ticker that trades on TSX. So most of the numbers in this video are Canadian dollars. BCE or Bell Canada Enterprises is a telecom provider. It operates in three segments: wireless, wireline, and media. Bell Media operates a television network and owns part of the Montreal Canadiens. They also own several other sports franchises. Let's take a look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Pretty consistent free cash flow, except in 2021, it was low, a little over 1 billion. But besides that, between 3 and 3.5 billion. It tripled from 2021 to 2022, growing 200%. And their margins look decent. They convert 13% of their revenue into free cash flow. But if you look at their yield, it's 8.7%. And when you multiply their yield by their market cap, that's how much dividends they have to pay out, 3.5 billion, which is less than their free cash flow. So something has to give. Either they lower their dividend or they need to raise their free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's fairly consistent. 2.5 to 3 billion a year. It was lowest in 2023 at 2.3 billion, down 20% from 2022. Their margins dropped from 12% to 9%. That's not what you want to see. Net profit margin is net income divided by revenue. It's how well you convert your revenue into net profit. Revenue is a sales for the company, and that does go up each year, but not by much, only 2 to 3%. Their revenue per share is $27.28. Generating nearly 25 billion of Canadian dollars in 2023. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 68 billion. We discounted those numbers back to today's and the weighted average cost of capital. We get a value of the company of $59 billion. We divide that by 900 million shares. And we get a calculated stock price of $65. They're trading at $45, so they're trading at a 31% discount. It's a pretty strong buy according to the model. But the stock does keep coming down, but it seems like a staple in Canada. They've been around so many years, about 150 years, and they touch pretty much every single part of Canada. So it's hard to imagine this company going bankrupt. So if they're not going to go bankrupt, the stock has to come up at some point. It just can't keep coming down. All their numbers are converted to US dollars because all these tickers are trading in the US. So that's why this chart is in US dollars. But all the other numbers in this video are in Canadian dollars. Telecom companies spend a lot in CapEx. There's a lot of maintenance and infrastructure. They spend 2.6 billion. Look at Verizon, 19 billion. T-Mobile, 10 billion. AT&T, 18 billion. It's really expensive to maintain these companies. They're really leveraged, which is a concern. For every dollar of equity, they have $1.80 of debt. And the reason people like the stock so much, look at the dividend, 8.7%. But they can't maintain this dividend because they're not bringing in enough cash flow. So that's why the stock price keeps coming down. Vodafone pays 10.7%. Also, it's hard to maintain these big dividends. But 6.2% is maintainable, especially with 19 billion of free cash flow. They generate 2.3 billion of free cash flow, which is a little higher than the average. They rank 7th in market cap. T-Mobile is number 1 at 192 billion. Verizon and Comcast are really close. AT&T divested Warner Brothers, so they're a lot lower. Those are the big 4. Everybody else is far behind. They trade 2 times book value, which is equal to the median. They trade 17.5 times earnings, which is better than the median average. Look at Vodafone, 2.2 times earnings. This looks really undervalued. They trade at 13 times free cash flow, a bit better than the average, a little worse than the median. And they trade 1.6 times revenue. So they do generate a lot of revenue relative to their market cap. Look at Verizon, 134 billion of revenue. They trade at 1.3 times revenue. Once again, Vodafone is number one. They trade at 0.5 times revenue, which means their revenue is double their market cap. When you hear trading at 0.5 times revenue, that means their market cap is 0.5 or 50% of their revenue. BCE is still growing, but by very little. Their 5-year annual revenue growth rate is 1%. Look at T-Mobile, 13%. Liberty Broadband, 113%. Amazing growth. Let's take a look at the company's annual report. This is for 2023. 5G is the big thing in telecom, and they cover 86% of the Canadian market. Also in 2023, they added 633,000 fiber network homes and businesses. They also produce content. They produced 38,400 hours of original content last year. They are a dividend aristocrat. They raised their dividend 3.1% in 2024. They've been paying a dividend for decades. Let's look at their income statement. Revenue for 2023, 24.7 billion. That's up a little. It was 24.2 billion last year. Of the 25 billion of revenue, 22 billion is Bell CTS, Communication and Technology, 2.8 billion Bell Media. And the EBITDA for CTS is 9.8 billion. The EBITDA for Media is 700 million. Here's a breakdown of their revenue. Of the 25 billion, 7 billion is wireless, 8 billion is wireline, 2.9 billion is voice, 2.8 billion is media. That's all the sports teams they own. 21 billion of their revenue is in services, 3.5 billion in products, 2.9 billion in wireless, 600 million in wireline. Total product revenue, 3.5 billion. Here's a nice high-level view of their numbers. 25 billion of operating revenues, net profit 2.3 billion, EBITDA 10 billion. Their EBITDA and revenue are up 2.1%, net profit down 21%. They have 10.3 million mobile phone subscribers, up 3.4%. High speed, up 5%, 4.5 million subs. Retail TV down 1%, 2.7 million subs. Operating cash flow 7.9 billion, down 5%. Free cash flow 3.1 billion, up 2.5%. Here's a nice view of their income statement with the change in percent. So their revenue is up 2.1%. Operating costs down 2%. Their operating costs 14.3 billion. So adjusted EBITDA is up 2%. It's 10.4 billion. Last year, 10.2 billion. The EBITDA margin is 42%, so they convert 42% of their revenue into adjusted EBITDA. They have a lot of fixed assets, so they have depreciation and amortization, a ton of debt on their balance sheet. They paid 1.5 billion of interest on their debt, so their net earnings is 2.3 billion, down from 2.9 billion. Their earnings per share is 228, that's down from 298. Their shares outstanding are up a little bit from 911 million to 912 million. Let's take a look at their balance sheet. Current assets of 8 billion. Current liabilities of 12 billion. That's not good. Their current ratio is well below 1. They're going to need to add some debt to get through the next 12 months. They have about 1.8 billion of cash and short-term investments. Receivables 4 billion. This is how much money other companies owe them when they sell on credit. Total assets 72 billion. That's up from 69 billion. Their biggest asset is PP&E, 30 billion. They also have 11 billion of goodwill. Their total liabilities are 51 billion, up from 47 billion. Their biggest liability is long-term debt, 31 billion, lots of debt. Here's a breakdown of the debt. 20 billion has a maturity between 2024 and 2053. Not that much information. They do pay a low rate, 4%. 1 billion, they pay a high rate, 9%. They pay a low rate on this, 3.5% on 7.5 billion. They have lease liabilities of 5 billion. They pay 5.8%. This is when they lease assets from other companies. So their debt went up quite a bit from last year, 28 billion to 31 billion. 5 billion of their debt is due within 1 year. So they're going to need to refinance that debt. That means they're going to take on new debt to pay off the old debt. And interest rates are getting higher. So that's not good. Assets minus liabilities equals equity, 21 billion of equity. They raised 3.7 billion from selling preferred stock. Preferred stock is higher in a capital structure than common stock. They get paid before common shareholders in the event of a bankruptcy. Common shareholders are at the very bottom of the capital structure. They get paid last, usually nothing at all if there's a bankruptcy. They raised $21 billion from common stock, and they lost $5.5 billion from running their business. Deficit, in the US we call this retained earnings, or if it's negative, it's accumulated deficit. This is the sum of all their prior net incomes minus the sum of the dividends they paid out. Let's take a look at a statement of cash flows. Even though their net income is only $2.3 billion, they generated nearly $8 billion of cash flow. That's operating cash flow. The reason they generate so much is because they have lots of depreciation and amortization, nearly $5 billion. That's a non-cash expense that brings down your net income, but we add it back here. They spent a lot on CapEx, $4.5 billion, last year over $5 billion. They spent $222 million in business acquisitions, last year $429 million. In their financing section, they added $5.2 billion of long-term debt. They paid down $1.9 billion of long-term debt. Last year, they paid down more debt than they issued. They pay a lot in dividends, $3.5 billion, last year $3.3 billion. So in their financing section, they had a cash outflow of $1.5 billion. Last year, a cash outflow of $3 billion. Let's take a look at the company on Simply Wall Street. Its last price, $41 billion market cap, down 4% in the past week, down 29% in the past year. Let's see what they say about the company. BCE provides wireless, wireline, internet, and TV services to residential, businesses, and wholesale customers in Canada. They have two segments, Bell Communication and Technology Services and Bell Canada. The Communication and Technology Services segment provides wireless products and services, including mobile data and voice plans and services. Wireline products and services comprising data, including internet access, internet protocol television, cloud-based services, and business solutions, as well as voice and other communication services and products. Also, satellite TV and connectivity services for residential, small and medium-sized businesses, government, and large enterprise customers. They buy and sell local telephone, long distance, and data and other services from or to resellers and other carriers, and operates consumer electronics retail stores. The Bell Media segment provides conventional TV, specialty TV, pay TV, streaming services, digital media services, radio broadcasting services, and out-of-home advertising services. They were founded in 1880 in Verdun, Canada. Verdun is located in Montreal, Quebec. They've been public a long time, several decades, and you could see they really peaked in 2000, over $218 a share. That would have been a nightmare if you bought it back then. It came crashing down in the mid to late 2000s. Then it looks like it traded sideways for around 8 years, dropped to the low 20s in 2008. It ran up to over 60 in the beginning of 2020. Then in March 2020 came down to the mid 40s, then ran back up to over 70. That was in April 2022. But ever since then, it's been coming down a lot, especially this year. It started the year in the mid 50s. Now it's in the mid 40s. Simply Wall Street is really bullish on this one. They're at $118 a share. They say the stock is 42% undervalued. 17 analysts priced this stock at 54. They also say it's undervalued. Their revenue forecast for the next few years is pretty flat, around $25 billion. And their free cash flow for the next few years looks really bullish, from $3 billion up to $4.3 billion. If they do grow to $4.3 billion, they can maintain their dividend. Their revenue hasn't grown too much the past decade. It was $20 billion in 2013. Now it's $25 billion. A big concern is all the debt they have. It was $18 billion in 2013. Now it's over $30 billion. And their equity is a little lower than their debt. That's why they don't have a great debt to equity ratio. This green line is their cash. They keep almost no cash on their balance sheet. Look at their payout ratio, 170%. If it's over 100%, that means their net income is lower than their dividend. That's not really sustainable. Even though they have a lot of debt, the stock's going down, they still continue to pay a nice dividend. It was 5% in 2014. Now it's close to 9% because the stock price came down so much. So either the stock price will go up or they need to cut their dividend to be more in line with the stock price. but the forecast is for their yield to grow close to 10% by 2026. You can see in the past decade, they haven't cut their dividend. It grows every single year. Currently, they pay $4 per share for their dividend. The CEO's salary was $500,000 in 2017. Now it's 1.4 million Canadian dollars. Total compensation $13 million. His tenure as CEO is 4.3 years. There's been a lot of insider activity, mostly buying, although there's some sells. Actually, the number of shares sold is more than the number of shares purchased by insiders. 56% of the companies held by the general public and 44% by institutions. BMO, Bank of Montreal, is the biggest shareholder at 4%. Royal Bank of Canada, CIBC, lots of big Canadian banks own the stock. Bank of Nova Scotia, Deutsche, TD, Toronto Dominion, Merrill Lynch, Canada Pension, Goldman, Federated Hermes. They are cutting their employees, doing some cost cutting to save expenses. It was 56,000 in 2013. Now it's 45,000. Their ticker trades on the New York Stock Exchange, Toronto Stock Exchange, Deutsche Börse, and Bulgaria. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.